and welcome to The Money Show, the only show of its kind which brings the market's top financial experts to answer all of your financial queries. I'm Avni Raja, with me, Avan Dubash. Hi Avan.
Hi Avni, and yes, we will be answering all of your queries in just a bit, but let's just recap some of the top stories for the day. First up to the markets, the sell-off entered day 3, the Nifty continued to pull back below 10,200, volatility as well took a knock and all sectors were in the red with the broader markets bleeding.
After the success met by the government in launching ETFs in the past, their latest offering is the Bharat 22 ETF managed by ICICI Prudential AMC. Bharat 22 ETF is a long-term investment opportunity with stocks of 22 companies under this ETF.
Meantime, mutual fund AUMs touched an all-time high of 21.4 lakh crores as on October 31st, of which equity AUM stood at about 6.3 lakh crores. That's the latest data that we've got as per AMFI, and SIPs as well saw their monthly collections growing to 5,600 odd crores in the month of October. Those are your top stories. Let's kickstart the show by bringing on board Roongta, our personal finance expert, who will be addressing all of your queries as well as giving us his individual mutual fund expert advice. Before we proceed then, let's talk about a new fund on offer and wanted to get in your review really about the same. So much talked about it. The ICICI Prudential Mutual Fund has launched the Bharat 22 ETF. It's the launch date was about 14th to the 17th of this month. Would just wanted to get in your perspective as to how you're looking at this, because it's a mix of really a lot of the heavyweight companies in the private sector as well as some of the heavyweight PSBs. What's your outlook?
So I'm just giving an outlook for the lay investor. And so if you look at the background behind this, what the government has really done is to mix some of the private sector stocks it was holding via the UTI rescue vehicle, the special undertaking for UTI, that roughly 40% between ITC, L&T and Axis Bank, and the balance 60% is a mix of PSUs which are finance, industrials, energy, etc. My point is there is no coherent theme in this ETF. So I would say that for a lay investor, this really should be a pass opportunity. I don't really see any significant thing. There is a 3% discount, yes, but a 3% discount should not really make you buy this. It has to come out of your existing equity allocation, and I can't see why you would want to sell some other equity to buy this. And obviously, unlike any other mutual fund, this is also a mutual fund, it's quoted on the exchange. Unlike a regular mutual fund which you can buy on a systematic basis, this one you can't. So you have to get out of some other equity to get into this, and I see no reason to do that.
And what if you had to, if you don't have to get out of something, but you're looking to deploy and you're looking perhaps to invest into an ETF itself, would you then say that this could be one of the options if you're putting in fresh money?
So if you want to put money in equity and in a lump sum, right, and ETF is your choice simply because of the low costs involved, I would much rather prefer a index ETF rather than this. Because this, as I say, is a very strange mixture, and it's coming out of the compulsion of the divestor, which is the government. Right. Otherwise there is no coherent theme around all the stocks that are together there.
All right, so that's the view as far as the Bharat 22 ETF is concerned. But moving on, our first question comes in from Jignesh Shah, who sent us a question on Twitter and asks, which is the best performing mutual fund at present? Which one should I invest in for the long term? Harsh, this, the highest returns, best performing fund, these are questions that we keep getting a lot typically. What would be advice, and also, for the broader questions that we get like this?
The standard answer for this was that if there indeed was a best mutual fund, why are the other mutual funds existing? Obviously, so it depends on what your need is, okay. I think this quest to find the winner actually inevitably ends up in, at best it ends up in disappointment, at worst it opens the door for charlatans who will come in and promise the moon to you. So one needs to be very careful about using mutual funds to using them in the same way that say you would, what is the best stock to invest in. I think when you invest in a stock, the key is there would be some winners and some losers, so it would be in a mutual fund, but because it gives you diversification, an equity mutual fund, it tends to give you almost average market returns, or in the case of India at least, here actively managed funds are giving us slightly better than the average market returns. It reduces your risk, and therefore I think much more focus should be on the type of mutual fund you want to invest in. Do you want to invest in equity mutual funds? Do you want to invest in hybrid, whether balanced equity saving? Should you be investing in debt? I think that is a much bigger question that you should be asking and answering, rather than which is the best mutual fund.
Okay, I hope you've taken note of that advice, and to a lot of our viewers as well who keep sending in those kind of queries. There really is no one best fund. It is so important that you also take note of, keeping, sticking with a mutual fund through inevitable ups and downs, because that of course is all part of the game. But do remember to keep an eye on your goal. What your financial objective is also very important, as has been stressed by Harsh. Let's move on then. We've got loads of other queries as well, and we've got a query coming in from Lalit Mishra on Twitter. He says, for a 3-year plus time horizon, which debt mutual fund will be a suitable alternative to fixed deposits? And Harsh, if you could just outline for us firstly if it would be more prudent to switch to a debt mutual fund as an alternative to a fixed deposit. If so, why? With comparisons and pros and cons.
So very clearly, assuming that you're paying taxes, that your taxable income is more than 5 lakhs, then I think a debt mutual fund makes far more sense than a fixed deposit does, because tax wise it's very friendly. Now all of us know that if I hold on to a debt mutual fund for 3 years, post that it is treated as a long term capital gain when I redeem it, and therefore the gains would be taxed after providing for an indexation, which means it would be taxed at a much lower rate at 20%, and that too after providing indexation. So effective tax rate would come out to about 3 or 4%. The other advantage which fewer people realize, that even if you are withdrawing during those 3 years, when you withdraw from a debt mutual fund, most of your withdrawal is the principal portion, only a very small portion is interest, and only that is taxed. Yes, that would be taxed during the first 3 years at the normal rates, but it is such a small portion of what you withdraw that the overall taxability of a debt mutual fund is much lower as compared to a fixed deposit. Therefore, the base assumption is you are paying taxes. If you are not paying taxes, you probably are equally well off between a fixed deposit or a debt mutual fund. What kind of debt mutual funds? I would say you should look at, depending on your requirements. If you are very risk averse, you could look at a short term, maybe even an ultra short term mutual fund, so that neither is there a credit risk nor is there what is called an interest rate risk, because when interest rates rise, your returns would fall. I think every fund house would have an offering there. I think two that we have mentioned. There is an HDFC floating rate income fund or an Aditya Birla Sun Life short term fund, but every fund house has. So ICICI would have ICICI Prudential Flexible Income, every fund house. So depending on the fund house you like, you can pick up a suitable short term or an ultra short term fund.
Right, Lalit, hope you've got the answers that you were looking for and made note of all that advice. Clearly, fixed deposits, debt funds are much better than fixed deposits, especially with the falling interest rate environment. But on that note, let's slip into a quick break. We'll continue with more queries on the other side. Meanwhile, do send in all your queries for The Money Show. You can call us on 2483-71777. You can drop in an email, themoneyShow@etnow.tv, or even connect with us on Twitter @etnowlive.
still tuned into The Money Show, and we're getting all of your queries answered as well as talking about some interesting topics, and we also assessed the latest ETF offering, the Bharat 22. Let's move right on then and talk about some more topics of discussion. Currently, we have Harsh Roongta, personal finance expert, with us in our studios. And Harsh, we discussed this. We got our first query from Jignesh, who said, what is the best performing mutual fund at present? And, this sort of just works into the psyche of everyone, asking for the best. It's a big disappointment when, people lose money. But if you could just give us your assessment for the quest for the best, really.
Well, the quest for the best can lead to the worst, possibly. I mean, it is a dangerous quest to have. It reminds me of what my professor used to tell me in college, that all of you must work hard so that all of you can get marks above average. Now, that is a statistical impossibility. I think clearly, when you invest in, say, specific stocks, some of them would perform above the market, some of them would perform below the market. You would end up, maybe either losing or gaining, depending on which side of the divide you invested in. The advantage of investing through mutual funds is that you get a broader basket and therefore you get diversification. The disadvantage obviously is your returns would tend towards the average market returns, but that's not a disadvantage really, because if you look at the average returns that the market has given, if you look at, say, the Nifty and you look at 10-year SIPs, that the market returns that have come in, the average returns have been as high as 15% plus 10-year SIPs. Now, if you are able to get that, I think you should be pretty happy. So, I think the key to investing properly is making sure that you have realistic expectations from your investments, being disciplined about your investments. They're going to go up, they're going to go down, stick to them, and then you will be able to reap the rewards. Don't try to go after the latest fad. Don't try to look at every single opportunity. I mean, this is a market, right? Instruments are going to be thrown at you at every point. Remain simple, have a simple strategy, be disciplined, and I think the rewards will be yours. Be realistic about what those rewards you want, and I think those rewards really will be yours.
Right, so be disciplined and keep your goals in mind, all things which will ensure that your returns are good instead of running after the best and the highest performing mutual fund there. Well, moving on, our next query comes in from Pasari Chetan, who sent in a question on Twitter. Says, I'm a new investor in mutual funds. Guide me with some basic rules, do's and don'ts. Harsh, a new investor coming in, wanting advice, our do's and don'ts, basic rules. I'm sure this applies to a lot of people out there who are looking to enter and start investing into mutual funds. In fact, we've seen Amphi data showing that AUMs are at an all-time high as well.
Right. Absolutely. I mean, if you look at, say, the SIP book, etc. Now, I think people, when we talk mutual funds, people think mutual funds equals to equity mutual funds. And I think some of the principles, keeping things simple, being disciplined, we have already spoken about. But let me talk about this, what shall you say, the highly regarded animal called the systematic investment plan, or the SIP. Now, obviously, I think everybody has heard, and thanks to the high voltage campaign also that is being done, everybody knows that SIP is an excellent way to reduce the risk of equity fluctuations. The only issue with that, I think, again, if we take the example of a 10-year SIP, at the end of 10 years, obviously you find that the returns are good. In fact, at any point, if you have done a 10-year SIP, the minimum return that you would have got is 6%. I mean, that was, say, from February 6 to February 2016. In the Nifty, if you did a SIP, that would have been your return. That's 6% per annum net of tax, not bad at all. The average is 15%. But what this really hides, I think, and that is what I really want to point out to people, is that making it less risky doesn't mean that, like a fixed deposit, you will see some increment every time. During those 10 years, it is going to go up and down. In fact, if you analyze the 3000 or odd SIPs that you could have done, 10-year SIPs that you could have done in the Nifty from 3rd November 95, fully 98% of them would have negative capital somewhere in between. In fact, about 28% of them would have had negative capital after 60 months. That's, you've done SIPs for 60 months and you still forget return. There is negative capital in 28% of the time. So, SIP is a great vehicle, superb vehicle, but please have the right expectations. The returns are going to come with patience and discipline. In between, if you stop during the time when you supposedly are having a loss, that is the time when your wealth is being built, and if you stop, then how is your wealth going to be built? So, I think understanding that is extremely important.
Okay, I hope you've taken note of that advice coming in, and you know, we have lots of questions as well from viewers who are watching us, and I'm not going to put you in the spot, Harsh, because this is something that we just discussed on the show. Mr. Kulkarni connects with us and wants to know, I mean, he's not connected, he's actually posed a question to us. What is the minimum amount to be invested in the Bharat 22 mutual fund? We just discussed it in detail, and it's a minimum of about 5,000 rupees, and if you could just give us your views on the same. Harsh, if you could just give us your views on the Bharat 22 again.
I think we spoke about it right in the beginning. So, as I mentioned, it is a collection of public sector and 3 private sector stocks. There isn't a coherent theme. So, there is nothing special about Bharat ETF. So, I would say there is nothing that is great about the Bharat ETF that you should take money out from somewhere to invest there.
And the minimum amount is 5,000, am I correct?
I wouldn't be too sure of that.
Okay, fine. All right, I hope we were able to answer your question. Yes, the minimum subscription amount is 5,000 rupees. Okay, I'm afraid then we're completely out of time, so we'll have to call it a day. Harsh, appreciate you taking the time out and joining in, helping our viewers out with their queries. Keep those questions and queries coming in. This is